my name is Brad Long, Deputy Chief Investment Officer at Fiducient, and we're going to talk a bit about inflation. Today's January 2022, and the Bureau of Labor Statistics announced today, as measured by CPI, that inflation rose 7% year over year. That's the highest level since Michael Jackson released the Thriller album in 1982. For those doing the math, that's 40 years. So how did we get here? Well, if we break down the 7% into three very broad buckets, we can see food, energy, and all other items. They had very different experiences in 2021. Energy is up nearly 30% and contributed approximately a quarter of the top line figure of 7%. This was primarily driven by motor fuel up 50%, which is the sharpest rise in fuel figures since the 1980s, when US consumers were plagued by low fuel supplies and long lines at the gas pump. An honorable mention to used cars and trucks up over 37% due to semiconductor shortages and COVID-related production delays, and had their best year since 1975. With prices moving up quickly, what do we do as investors? Well, first, let's take a deep breath. The likelihood that inflation stays near 7% is fairly low over the intermediate term. Let's take our two examples above, energy and used cars. Used cars are often described as the quintessential depreciating asset, as new cars lose value as soon as you drive them off the lot. Used cars were benefited in 2021 from low supply of new cars, but also rental car companies restocking their fleets after selling their cars in 2020 in hopes to stay in business. And energy. It wasn't too long ago that when WTI, US oil, had a negative price print in 2020 as investors reconciled the impact from shelter-in-place orders and sold those assets. WTI today, at the end of 2021, trades around $80. These extraordinary events do not have a clear sequel for a repeat performance in 2022 and continue to put upward pressure on prices. So while these figures are eye-catching, they're likely to fade in our view, and upward pressure may cease. With that said, though, we do not believe that CPI will retrace straight back to the 1% to 2% year-over-year changes we've seen and been accustomed to over the last 2 decades. Persistent inflationary effects, like higher wage pressures, housing, may keep inflation in the 3+% range for some time to come. For more insights on our approach to guarding against inflation, please visit our website, fiducientadvisors.com.